Hi guys and welcome to Finspire, and in this video we will talk about the expiry day trading. And in the last particular video we have already talked about what trade we have taken on this expiry. Today we are going to talk about how that trade went and what you should do and what should be your thinking around that trade. Okay, so basically these two particular trades you can take around the expiries, and these are the very plain and basic trades. So let me just show it to you that how this particular thing works. So most probably you might have heard of these two particular things, but to execute this, you require a high level of understanding about the smart money, that where actually they are in the market and where they are trying to take the markets. So basically, if you are new to the markets, then let me tell you one thing. Financial market is being driven by smart money, which is basically the people who have a lot of money. And these are only 5% of the market participants, and the rest of the 95% of the market participants are people who are losing money in the markets and they are doing some stupid option buying stuff. So basically, if you want to make money in the market, you just have to track those 5% of the people, where they are, what they are doing, what their plans is, and rest of it. So let me explain it to you, the two trading strategies which you can apply on any expiry day. Condition is that the market should be sideways around those expiries. Now, how will you identify that? That's a part of Inspire Masterclass that we'll only discuss in the masterclass. Now, here in this particular case, as you can see, any day which is a sideways, you can do these two things. First is you have to identify a mean position. Now, what is mean position? Is a position where the market has, is coming around and, is passing around that position or touching that position for quite a number of times. For example, in this particular day, this is the mean position, which is 43,400. Now, why I'm saying so? Because I can see it clearly based upon the overall smart money data that what is the current mean position of it. And here the currently the same again, the mean position is this 43,200, I guess. Yeah, 43,200. Now, in this particular case, we have taken two trades, and I will explain you both the trades, how they have worked out. Okay. First, let's talk about the mean position trade. So this was the today, this blue line, as you can see, after this was the today's day. Now, in this particular day, first you need to understand what is happening around in the market in the morning. So there are a couple of things which happens around in the morning. There is the long unwinding, short covering, long built up, overall. So if you understand all of these factors, it will be easy for you to predict the direction where the market is probably trying to move. And in with this particular case, you can just do that, you can make your trading strategy in that direction. For example, if the market is trying to go in bullish direction, you can make your trading strategy in a bullish direction. Similarly, in the bearish, you can make it bearish. If the market goes sideways, you can hold your trading strategy for a while. But if you'll see here clearly, we have booked the profits in the morning. Why? Let me just give you an explanation to that. Now, first thing first, let's talk about the first trading strategy, which was basically the mean position trading strategy. Now, in this particular case, since I've told you 43,200 was the mean, but 43,200 for a mean position, you need a good premium. So this is the trading strategy that we applied on this. Let me just refresh this so that people not have any concerns. Now, 43,200 is at the money. Why we shorted at the money both call and put option? Because there was a good enough premium for any option seller to capture. And a discounted rate was that we actually hedged it with the calendar expiry, which you can find it in the previous couple of videos that we have uploaded already. Now, second most important thing is that we actually try to short the market in the range. So that is the second trading strategy, which I'm going to explain it to you right now. So basically, as you can see here, these are the two blue lines here. One is here, one is here. These are the key levels of the market where the market was supposed to end in between of these ranges. Now, how do you identify that range is again a part of the masterclass, but this range identification is important if you are applying any trading strategy, or if you are trading directionally. This is really important, because once your range gets breached, what adjustments you have to do, that is an important part. Now, in this particular case, as you can see clearly, the market opened flat, and we knew that market will open flat. You can just just review the previous version of this video. I mean, the previous video of this. And the market was flat, and we finally decided to exit around a position when the overall OI was shifting around. So this is the place where we exited, and we ended up making couple of 5,000-6,000 rupees in this trade. Now, this was just traded with couple of lots. You can trade this trading strategy with as many lots as you have, as many margin as you have. Now, here the important understanding is the expiry, which is of the current week, has given us less profit. versus the expiry of the next month, which has given us more profit. Now, this is a real catch behind the trade, that the next week expiry had a more decay in the options, whereas the current week expiry had a less decay. So let me tell you at the profitable part as well. So as you can see here clearly, these particular two positions, which is the basically the at the money shorting, has given us a profit of about 1000, like almost, if I say close to 1700 or 800 in just one lot. Now here, as you can see, this particular thing has given a profit. I mean, if you remove this, hedging legs, which is basically the part of it, if you remove this, then you will just see it has just given a profit of 4000 rupees. So one single lot has given you a profit of almost 1800, whereas almost, I think, 3 or 4 lots, something like that. I forgot how much was the number. Yeah, it was 4 lots. So 4 lot is the number, and the 4 lot has given us a profit of about almost 1000 rupees per lot. So that is the difference between trading within a range versus trading at the money. So if you want a higher risk on your trade, you can trade at the money. If you want a lower risk and a lower reward, you can trade in the distance. So this is how this overall trading strategy works. Now there is a lot behind that happens in order to track everything, and that particular stuff is a part of the FinSpire Masterclass. So that's it, guys, in this video. If you have any questions, just let me know in the comment section below. And if you want, us to create some videos on certain topics, just let us know in the comment section below, and we'll see you in the next one.